What if I told you that most of the money made through investing in real estate, specifically here in the Lower Mainland, is done by doing absolutely nothing after you've bought? You might be wondering, what exactly do I mean by this? So let me explain. First, you need to understand the 4 ways that you can make money through investing in real estate. Number 1 is cash flow. This is the amount of money left over from your rental income after all expenses have been paid. You could also have neutral or negative cash flow where you're actually paying money out of pocket. But in general, you definitely want to aim for positive cash flow. Number 2, principal paydown. When you have a mortgage on a property, your payment goes towards principal as well as interest. So the principal portion is the amount of money that is paying down your mortgage and building equity in your home. Number 3, active appreciation. This is when you increase the value of your property, typically through renovations. And number 4, passive appreciation. This is an increase in the value of your property due to changes in the market over time. So let's take a look at the average homeowner in Vancouver who has owned their home for more than 10 years. During this time period, prices are up over 60% or nearly $1 million. And if you go back closer to 20 years, those owners are up over 350% or nearly $2 million. And from doing what? Nothing, just owning their homes. That's why in this video, we will be discussing what exit potential is. So first, let's define it. Put simply, exit potential is the term used to describe the likelihood of an investor being able to sell or exit an investment property at a profit in the future. In other words, it refers to the potential resale value of the property. Exit potential is an important consideration for real estate investors because they typically aim to generate a return on their investment by selling the property for more than they paid for it. The exit potential of a property can be influenced by factors such as location, market conditions, property condition, and demand for similar properties. Investors may use various strategies to enhance the exit potential of an investment property, such as making renovations or improvements to the property, choosing a desirable location, and purchasing the property at a price that allows for a potential profit upon resale. Ultimately, a property's exit potential is just one of the many factors that investors should consider when evaluating the potential returns and risks of a real estate investment.
Something that's very important to note as an investor is that number 1, yes, you can make passive appreciation money over time. Now, also, you can actively add value over time. So you have something called passive appreciation, number 1. Number 2, it's called active appreciation. That's when you're adding value over time through active things that you're doing to the property, renovations and other parts of the whole scenario. So if you ask any real estate investor, they will always very counterintuitively say that for active appreciation, a lot of the money you make on selling a property, or on the property rather, is actually made as you buy the property, not just when you sell it. So what is the renovation potential of that property when you buy it? But for now, for the purposes of this video, we'll just focus on passive appreciation, which is very important to understand the fundamentals of. And in the next video, we will talk more about this active appreciation and how you have more incremental exit potential.
To further explain the topic, let's go back to our example of the Kitsilano condo from our previous video. So the price of this condo is $625,000, which will be our starting value. Next, we want to use a realistic annual appreciation percentage. Over the past 20 years, apartments have gone up on average by 7% annually in Greater Vancouver. Of course, there are no guarantees that this will continue, and year over year, fluctuations vary in either direction. But when you average it out over the long run, this is what we've seen. For this reason, I like to take a more conservative approach and use a 3% annual appreciation rate. This way you're hedging your bets, and anything on top of that is just going to be a bonus. Next, you want to consider your number of years to exit. This is the minimum period of time prior to you considering selling the unit, at least for the purposes of this calculation. We generally don't suggest a timeline under 3 to 5 years at the minimum, and ideally you never want to sell it. However, we do understand that that's not going to be feasible for everyone, and there may be other opportunities that could cause you to consider selling it. But we do want to mitigate as much risk as possible, and the best way to do that is with time in the market.
This ties into our projected home value calculation. Pretty simple. All we do is we take the 7% annual appreciation, we times it by 5 years, and now we have the projected home value after 5 years, which is just over $876. Keep in mind, we have not used any active appreciation, i.e. using renovations or anything that you can forcibly and actively do to further increase the home value. Based off these numbers, you can now calculate the predicted ROI percentage. So the return on investment percentage is 201.3%. That's the gross return. But don't forget, when you're selling a property, there are other fees that will come up inevitably. So that will be something you of course have to calculate to get your absolute profit from selling the property.
The biggest takeaway here is that you should be taking a long-term approach to real estate investing and planning for the worst but hoping for the best. This way, you'll reduce your level of risk while putting yourself in a position to be the most successful, as even if things don't turn out ideally, you've set yourself up to be successful in the long run without taking any major short-term loss. And if things go better than planned, that's just the cherry on top. If you're a little more curious now than before this video and want an insider scoop on places that give you a holistic ROI
without your finances and your health falling apart, then book us below for a chat.